Hello, everyone. I'm Matt Clark, research analyst with Money and Markets here. And joining me as he does each and every week is Green Zone Fortunes co-editor Charles Sizemore. It is time for another episode of Investing with Charles. Charles, welcome. Thanks for joining. And I'll just start off. I'm not a negative guy, or at least, not usually.
You're certainly cramping my style, man.
I know, as I usually do, but it's hard to, you just can't, as an investor or if you're in investing services or anything like that, you just can't ignore what the market has done, especially at the beginning of the week. On Monday, it was just an absolute brutal day for the market. In fact, I think if I remember reading right, it was the worst day for the three indices since 2020. We saw the NASDAQ enter into bear market territory, albeit by 0.1%. And then we saw the biggest drops in the S&P and the Dow since, I believe, October of 2020. And this brings up something very interesting in terms of if you're investing. What does this mean? What do I do? There's a lot of panic. There's a lot of fear out there. Obviously, a lot of it is surrounding Russia and Ukraine. We can't ignore that as much as we might want to gloss over it. There's no getting around that. We see the world oil market turned on its ear. Oil prices are topping near around $120 a barrel, depending on if you're looking at Brent or West Texas Intermediate. Gas prices are up. Everyone is feeling the pain. There's talk of more sanctions. It just seems like to be this ball rolling downhill that's just gaining more and more momentum. But in terms of being an investor, the question here is what do I do? I mean, I might have this basket of stocks. I'm seeing losses in my portfolio, or maybe I want to get in, but I really don't know what to do. And I guess that's the question I'd pose to you at this point, because I think the game has kind of changed a bit here because we have seen this precipitous drop in the three major indices and stocks across the board. They may not even be part of any one of the three major indices. The Russell, the 1000, the Russell 2000, they're all down. They all were down at the beginning of the week. So, I'm just going to frame it like that. And then I know we have some data and some stuff like that we can share, but I want to just frame it like that and start the conversation off that way in terms of, what should investors be looking at this point, because the market started this week in such disarray.
Well, let's start with the damage. So it feels like we've just been beaten up like a punching bag here. I'm showing my age, but Mike Tyson in his prime, just pummeling away on us like a punching bag. That's what it feels like. But if you look at the chart, we're down about 12%. As we're recording this, the market's only down about 12%. That's really barely a correction. Now, what happened in the most recent? Well, let's just forget the whole COVID-19 bear market, because that really was sort of a special case. The world was ending, et cetera. Let's look at a better example. Fourth quarter 2018, what happened then? We had a near bear market in the S&P 500. The market dropped about 19%. It was rounding error away from an official bear market decline of 20% or more. Why? What happened in the fourth quarter of 2018 that led to that kind of damage? The Fed. The Fed had finally decided to get a bit more aggressive in raising rates. It had been really just extraordinarily accommodative policy ever since 2008, and the Fed had started to tighten up. That alone was enough to cause, let's just, for all intents and purposes, a bear market. A very, very mild one. I guess it didn't technically qualify, but for crying out loud, it's close enough. And that was just a garden variety Fed tightening. That wasn't, we didn't have this incident going on in Europe at the time. So what's different now? Like why is this potentially worse than that? What we have now is this potential that 30, 40 years of globalization goes into reverse. If Russia responds to its sanctions by restricting its oil exports, or if we shut off their oil exports, if you see this larger trend towards free markets being rolled back and countries not wanting exposure to pariah states like Russia or whatever the next pariah state may be. So they try to keep things more local. They try to bring supply chains closer to home. What does that do? Is that a recipe for stagflation? Is that a recipe for slower growth for a bit? Is it a recipe for higher prices? The thing is, nobody knows. And because nobody knows, the market's trying to handicap it. It's that technical term is price discovery. The market's trying to price in what this means. What does the post-Ukraine world look like here? Is it a world of higher prices, less globalization? Your guess is as good as mine. We're all going to find out together, but that's what the market's struggling with right now. So you also, and that's not even the worst part. The worst part is we're going into this at a time when stocks are extraordinarily expensive. And I've been sort of banging that drum here for a while. But even after this decline, this 12% decline in the S&P 500, that hasn't been enough to really move the needle much. If you look at some kind of standard valuation metrics, the price to sales ratio, the cyclically adjusted price earnings ratio. I like both of these because neither is too heavily focused on today's earnings, which can be wildly skewed by, the company has a great quarter, a bad quarter. It can really skew it in the short term. It's highly sensitive to the economic cycle, where the price to sales ratio is much less sensitive. The CAPE, the cyclically adjusted price earnings ratio, which is a 10-year average of earnings, far less sensitive to the current goings on in the economic cycle. So what does all this tell us? It tells us that even after this decline, stocks are wildly expensive by any historical time period you want to compare them to, even the dot-com bubble.
So, first off, to go back in looking at the S&P's total return, just this year, just taking year to date, the total S&P 500 return percentage is minus 11.6%. So you're right around 12% is where we're at right now, down in the S&P just starting January 1. If we backdate that a little further, that percentage gets off a little bit, but we haven't reached a bear market territory for the S&P.
Not even close.
No, we're looking at kind of a quasi correction area here, but then let's add in those metrics you talked about. We'll start with price to sales. I pulled some data, the S&P price to sales, and looked back from 2001 to 2022. So to take a 2-decade look at the S&P's price to sales. Right now, if you look at the chart, we've seen this kind of, it was very steady in the early 2000s. We saw a drop in 0809, obviously with the banking financial sector issues that went on there. After that, we saw a nice run up until that point in 2018, where we had the Fed decide to be more aggressive. Then we saw a bit of a turn down. It wasn't a dramatic one though. We're talking about going from 2.2 to 1.8. So it really wasn't, in terms of its ratio for the S&P. So it really wasn't that significant of a drop. Right now, we are at 2.85. That is the price to sales ratio for
recently
the S&P
over
500.
3, I might add.
Yes,
recently it was over 3.
It was recently over 3 in 2021 and into 2022. So it is, and that is the highest it has been in history. In the history of this metric being charted, the price to sales ratio for the S&P is still
significantly higher, as in nearly 50% more expensive than at the peak of the dot-com bubble, the late 90s, early 2000s. Like
by a long shot. Yeah, by a long shot. So even this recent market turndown that we've seen just in 2022 has done very little to make the S&P 500 what you would appear to be undervalued. It's still very much overvalued in terms of if you look at historical data. Now, switching gears and looking at the Case-Shiller price to earnings ratio, which is the CAPE, as you say, is a lot less sensitive to those one-off price movements. This is more of a consistent look.
It's a 10-year average of earnings. It compares today's prices to an average of the last 10 years of earnings. So the idea, why 10 years? Why not 5? Why not 100? Well, 10 years is generally in any given 10-year period. You've had a boom, you've had a bust, you've had everything in between. So it's a nice kind of smoothed out time period.
Right. It makes it a much more accurate in terms of fundamentals to look at in terms of data to really get a good picture. So if we look at that, I took that back from 2000 to 2022. So I missed out a little bit on the 90s when we had a massive run up and the PDE ratio, the CAPE ratio was over 40. I mean, this is where, it was up around the 43, 44 range in 98, 99. And then we saw a downturn in 08. into '09, a temporary, not even a big blip in 2018. The Cape did not make any massive movements in 2018 and 2019 when the Fed decided to become more aggressive. It did, however, take a bit of a drop in 2020 when we saw COVID come into play and stocks took a hit in March and then again in October. But now, even looking at it today, the Case-Shiller PE ratio for the S&P 500, 35.25. That's not 43. But at its lowest point in '09, it was around 14.
Yeah.
So we are almost 3 times, at least double where our lowest point has been in the last 20 years, even with this recent, again, 11.6% downturn in total return year to date for the S&P.
Now, one thing I would say is if you just sit in cash and you wait for the price to sales ratio or the CAPE or whatever valuation metric to get to a certain level before you buy, you may be waiting for a long time. And we may never see, never say never, but we may never see valuations as low as 2008 in our lifetime. That may have been a special situation that will not be repeated. I don't know, but we don't have to get to those levels in order for it to be attractive. There's a lot of room between where we are today and there. The issue is we're at the top end of the scale right now. I mean, I'd like for us to at least be somewhere in the middle before I started aggressively jumping in.
But I think what this suggests, and I'll ask you this, is that this may be a good time to kind of change up a strategy a little bit, depending on how you're investing, how your portfolio looks, and what your methodology is. And I'm not saying it needs to be a wholesale change in terms of your system, but because I think you still should keep your limits. I think you should keep your stop losses, things like that. None of that should really change. We've talked about that before. However, your broader strategy, if you're a buy and hold seller, now is probably a time to maybe change that up a little bit. Yes,
I would say so. So over really since 2009, if you had just bought and held growth stocks, you're sitting pretty. It was a fantastic, even throughout the 2020 pandemic bear market, that was over with in the blink of an eye. If you had just bought and held growth stocks, you'd have been fine. You would have had fantastic returns. That's just not the market we're in right now. It makes a lot more sense to be tactical. I think over the next 5 years, 10 years, this is not going to be a period where it pays to just buy and hold and hope for the best. This is going to be a period where it's going to pay to be more active. You're going to want to engage in more short-term trading. Even if the market goes through a lengthy repricing process, and this could take 5 years, it could take 10, who knows? Yeah, there aren't a lot of historical examples here. But if you look back to the last time we had inflationary pressures and sort of the falling apart of the existing financial regime, if you will, it would have been the 1970s. And from 1968 to 1982, it's a 14-year stretch. The Dow didn't earn a cent. It was flat for 14 years. We saw similar dynamics from 2000 to 2013. You can go through long stretches where you're just not making money in a buy and hold strategy. No problem. That's what trading is for. You can still eke out eke out makes it sound bigger. You can actually you can make great returns with a good, disciplined, short-term trading strategy.
Yeah, the key here is that, even though we are seeing a broader market turn down, or we have seen a broader market turn down here in 2022, it is not a time for panic. It's not a time for you to just go to your broker, whether it be online or whatever, call them up or dial them up or however you do it on your phone or whatever, and just sell everything. That is not the time for that. Smart investors like those.
Well, you don't have to liquidate your portfolio and buy canned goods and shotgun shells. I'm not suggesting. Although, hey, you may want to invest in a nuclear fallout shelter the way things are going, but your stock portfolio is not really going to help you if we ever get there. But no, what you make changes at the margin. This doesn't have to be extreme. You don't have to just dump everything and go to cash or go to mason jars in your backyard or whatever. It's at the margin. Take some of that portfolio, carve out at least a chunk of it, and dedicate it to more short-term trading strategies, something that is more nimble, something where your time horizon is measured in days or weeks as opposed to months or years.
Because as we've seen in the past, the broader market may be down, but there are still areas where profit can be made in a portfolio. You just have to, as you said, be nimble. I mean, that's the whole key here.
Look at energy. Energy and commodities are killing it. They are having a phenomenal year. So if you were more tactical, you were willing to diversify out of your kind of core growth stock portfolio and go to energy and commodities, you'd be sitting pretty right now. So it's about being nimble.
And that's the broader takeaway here. And that is that, it's not a time for rush selling, no panic selling, no panic buying. It is time to be tactical. It is time to be nimble. It is time to look at your strategy, maintain your price points, maintain your limits, your limit ups, and maintain your stop losses. Don't change that. There's no need to make any type of change there. But in terms of what you're purchasing, what you're selling, what you're buying, this is where you need to be more tactical. This is where you need to be more responsive, and not just kind of hope for the best and see what happens. Because again, it's the market. We've enjoyed the longest bull run in history. And as is with everything, things change. And we are seeing a bit of that change. How long does it last? We don't know. Does it last, a couple months? Does it last a couple quarters? Does it last a couple years? It's hard to say. There's really nothing, there's no data out there that says this is what it's going to be and this is how long it's going to last. So the smart investor needs to think on your feet, needs to say, okay, it's time for me to maybe allocate a little bit of my portfolio out to a more shorter term strategy, maintain all your levels. Don't change those up any, but be more tactical, be more nimble in terms of your responsiveness. Do you trade on headlines? No, because no one makes money trading on headlines. However, you can spot the trend. I have
yet to meet a person who has, I'll say that.
Nobody has. Don't know anyone who has. But the key here is to see, do some homework, or let us do the homework for you, because we do that, and find those sectors that are pricing in well and that are doing well, and start making some short-term allocations into positions in those areas.
And it's not just that. It's all. I mean, that's all part of it. But yeah, how does a trader think as opposed to how does a longer-term investor think? A trader goes into a trade knowing when they're getting out. What are the conditions? We're in the trade now, but when do we get out? At what target on the upside? At what stop loss on the downside? So that you need to think in those terms as well. You need to have, when you enter a trade, you need to know under what conditions you're going to leave, be they good or bad.
And that kind of leads me into, talking about, Green Zone Fortunes, which is our flagship product that we have at Money in Markets. This is where Adam and Charles and myself and our entire team, we work to provide these answers for you. We give you in-depth analysis. We give you a trading strategy. And we also give you those ups and those downs so that you know exactly when to get in or get out of a position. So we do all that work for you. And so that it takes the guesswork. It takes the need to be looking at your Thinkorswim or your Interactive Brokers or your TradeStation account on a minute-by-minute basis in times like this. Absolutely unnecessary. So we do that for you. We'll put a link up top so you can find out more so you can learn more about Green Zone Fortunes. In fact, we are now kind of finalizing a stock selection, a stock recommendation for you for this month that promises to do very well. It's in a market that handles itself very well in times like this, both in good times and in bad. And I think we've got a good position lined out for you. Again, we'll put a link up top so you can find out more about Green Zone Fortunes. So, Charles, that's what I have for you. Again, the takeaway here is know your ins, know your outs, be tactical, be nimble, don't panic, don't stress, don't look at your stock charts on a minute by minute basis. That doesn't do anyone any good. Just go into it with a plan. And if you don't have a plan, we are more than happy to provide one for you with Green Zone Fortunes. So he is Charles Sizemore. He's the co-editor of Green Zone Fortunes. I'm Matt Clark. I'm the research analyst for Money in Markets. Until next time, everyone, safe trading.